Welcome back to the deep dive. We got a lot of requests for this one, a real journalistic dive into the big three ETFs, QQQ, SPY, and VOO. So we've crunched the numbers.
We really have. We're going beyond just the tickers today. Think full sector analysis, fundamentals, technicals, the latest news, sentiment, valuation hints.
And that paper money math exercise people seem to like.
Exactly. We're simulating a $5,000 investment over the last year. See what could have happened. But, just a quick reminder, This is all based on historical data, hypothetical trades. It's definitely not investment advice.
Absolutely crucial point. And looking at these three, I mean, they're not just clones of each other, are they? They feel like different investment philosophies packed into an ETF wrapper.
That's a great way to put it. You've got QQQ, that's your high growth, maybe high stress Nasdaq 100 play.
Right. Heavy on tech.
Yeah, very tech focused. Then SPY and VOO, they both track the S&P 500, the broad market core, but they battle it out really on things like trading liquidity versus rock bottom costs over the long haul.
So aggressive growth versus foundational market access.
Precisely. Let's jump into QQQ first. Invesco QQQ Trust Series 1, the growth engine. What's under the hood telling us about the risk?
Well, the index itself, the Nasdaq 100.
Right, it's only, 102 holdings? That's incredibly concentrated.
It really is. So you're basically betting big on a pretty small group of mostly huge tech names. Concentration risk is definitely the headline there.
And that focus shows up in the costs and the income, or lack thereof.
Yeah, the expense ratio is 0.20%. That's, quite a bit higher than the S&P 500 funds we'll get to.
And the dividend yield, tiny, 0.47%. It tells you right away this fund isn't about income, it's chasing capital appreciation. You pay a bit more for that shot at, explosive growth.
And speaking of growth, the performance numbers are pretty eye-popping over the last year.
Yeah, 1 year return, 26.39%. That's huge. And even a 5 year strong, 18.52% annually.
That's the reward side. But the technicals, they tell the risk story, don't they?
Yeah.
You mentioned volatility.
Oh, yeah. The beta is 1.18. So if the market moves 1%, QQQ tends to move about 1.18%. Doesn't sound like much difference day to day, maybe.
But it adds up fast in a choppy market.
Exactly. Significantly more volatile. And look at the average true range, the ATR. It's 9.29.
Almost $10. So on an average day, you could expect the price to swing nearly $10 between its high and low.
Pretty much. That makes it tough to hold if you get nervous about, big daily drops.
And we've seen those drops recently. I mean, looking at the very short term, it closed at $609.74, but it was down over 3% just last week.
That recent weakness shows up in the moving averages, too. The SMA 20, the 20-day simple moving average, is negative 0.94%. For technical traders, that's often a signal, maybe a short-term sell trigger. Momentum's fading a bit.
And this sensitivity, this risk, it feels like it's mirrored exactly in the news headlines, right?
Totally. You see headlines about specific stocks driving QQQ down, like Nvidia sliding on some AI chip news. That concentration bites both ways.
And the overall sentiment seems split. One article asks, is QQQ the best tech ETF? And the next warns about a giant dot-com-era red flag.
That's QQQ in a nutshell. Polarizing. It's priced for massive future growth from its holdings, and investors accept that high risk, that high volatility, hoping for those big tech earnings to keep delivering.
Okay, let's make this concrete. Time for our $5,000 paper trade. Based on that $609.74 price, $5 invested a year ago gets you about 8.2 shares.
Roughly, yeah. And if you apply that huge 1 year return, 26.39%.
The paper profit comes out to $1,319.50.
Bringing your total hypothetical value to $6,319.50.
Wow, that really shows why people take on that extra risk. Over $1,300 profit on a $5,000 stake in 1 year. That's aggressive.
It is, and it sets the bar pretty high as we move to the S&P 500 trackers.
Okay, let's shift gears. SPY. The SPDR S&P 500 ETF Trust. This is the original, the benchmark everyone compares against.
It really is the OG index fund. Tracks the S&P 500, about 504 stocks. It is core U.S. market exposure. It's mainstream, just sheer size and institutional inertia.
When you say size, you mean liquidity, right? Easy to trade.
Massive liquidity. Average daily volume is over 73 million shares. Assets under management, the AUM, nearly $700 billion. Institutions, big traders, they love it because they can move huge amounts of money in and out, like instantly, without really budging the price. For them, liquidity is everything.
And the fund details reflect that sort of established benchmark role.
Yeah, expense ratio is moderate, 0.09%, better than QQQ, and the dividend yield is 1.08%, so it offers a bit more income, balancing growth and income generation better than QQQ.
Performance-wise, it's more about consistency.
Exactly. Solid returns. 1 year is 18.74%. 5 year is 17.04%. That's basically tracking the market standard.
And technically, it behaves like the market.
Pretty much perfectly. Beta is 1.01, right on the money. The RSI, Relative Strength Index, is sitting around 48.93, very middle of the road, not overbought, not oversold, typical S&P 500 behavior.
Okay, but even the benchmark isn't immune to pullbacks. Closed at $670.97, but perf week was negative 1.63%. SMA 20 also negative, minus 0.40%. So there's some weakness there too, though milder than QQQ.
Right. But here's where SPY gets really interesting. The money flow story. That's a bit contradictory.
How so?
Well, you see these reports of enormous daily inflows, like one day, boom, $10 billion flows in. That fits the narrative of it being the main trading vehicle for big players.
Okay, makes sense. Big tactical moves.
And this is the kicker. The year-to-date flow is actually negative, down 2.64%.
Wait, institutions are pouring money in daily, but overall for the year, money's leaving. How does that work?
It suggests SPY is maybe used more for those short-term tactical trades, hedging, quick bets, while the long-term buy and hold money might be, well, going somewhere else. We'll get to that.
Ah, okay. So traders use SPY, but maybe long-term investors are looking elsewhere.
Seems like it could be the case. And news reflects its broad nature. Tech sell-offs hurt SPY because tech is big in the S&P now, but the diversification dampens the blow compared to QQQ.
Got it. Let's run the SPY paper money math. $5,000 investment a year ago at the current $670.97 price that buys about 7.45 shares. Apply the 18.74% one-year return.
And your paper profit comes out to $937. Total value, $5,937.
Still a really solid return for just tracking the market. But yeah, about $380 less profit than the QQQ hypothetical.
That difference really highlights the risk-reward trade-off, and it leads us perfectly into VOO.
Right. The Vanguard S&P 500 ETF tracks the same index, S&P 500, 506. So basically the same job as SPY. What makes VOO different?
One word, really. Cost. VOO is the undisputed low-cost leader in this space.
How low are we talking?
Just 0.03% for the expense ratio, 3 basis points. Compare that to SPY's 0.09%.
6 basis points cheaper. That sounds tiny. Does it matter?
Over a few months, maybe not much. Over 10, 20, 30 years, that difference compounds into potentially thousands of dollars more in your pocket, not the fund managers.
Wow. Okay. And the dividend?
Slightly higher than SPY, actually, 1.14%. And it's AUM, the assets, nearly $788 billion. It's actually the biggest of the three we're looking at today.
Bigger than SPY. That's fascinating. That low cost must really be attracting long-term money. It's like Vanguard's whole philosophy playing out.
It is. They target the buy and hold investor, and it's clearly working. Since it tracks the same index, the performance is almost identical to SPY. But, just a tiny bit better because of those lower fees.
We see that in the numbers. One-year return, 18.80%. Just fractionally better than SPY's 18.74%. Same for the 5-year, 17.13% versus 17.04%.
And technically, it's a carbon copy of SPY. Beta 1.01, same weekly dip, negative 1.62%, same negative SMA 20, negative 0.40%. They move together.
So if performance and technicals are basically identical, the real story, again, must be the money flow. We saw SPY's negative YTD flow. What about VOO?
This is where it gets stark. VOO's year-to-date flows are strongly positive, up 15.79%.
Whoa, so money is leaving SPY overall, and a lot seems to be going into VOO instead.
That's what the traders needing instant liquidity. VOO for the long-term holders focused on minimizing fees. That seems to be the dynamic playing out. And the news around VOO reflects that. It's always mentioned alongside, like Warren Buffett's advice, buy the low-cost index fund and hold it forever. It's positions as that bedrock foundational holding.
Okay, final paper trade calculation. VOO. Current price, 616.89 cents. $5,000 invested a year ago buys about 8.1 shares. Apply the one-year return of 18.80%.
Your estimated paper profit is $940. Total value, $5,940.
$94. Wait, that's only $3 more than SPY over a whole year.
See? Tiny fee difference, tiny performance difference over 1 year, but it is better, and that edge accumulates.
Okay, let's wrap this up. 3 funds. QQQ. High risk, high potential reward. The growth play gave us almost $320 in paper profit.
Then SPY. The benchmark, the trader's tool, super liquid, gave us $937 profit.
And VOO, the low-cost twin of SPY attracting long-term money, gave us $940 profit, just edging out SPY thanks to fees.
So the choice really comes down to you, your timeline, your stomach for risk. QQQ offered nearly $400 more profit in this one-year snapshot, but you had to endure that 1.18 beta, those sharper drops.
Whereas with SPY or VOO, you got solid market returns with market-level risk. And the choice between those two seems to boil down to whether you prioritize SPY's liquidity or VOO's slightly lower cost. The flow suggests VOO is winning the long game.
Absolutely. And that raises maybe the most important point for anyone thinking long-term, like for retirement.
Which is?
We saw VOO beat SPY by only $3 over 1 year because of fees. And we saw QQQ beat VOO by almost $400 because of its aggressive growth tilt in that same year.
Right.
So the provocative thought to leave you with is this. How many years does it take for VOO's tiny 0.03% expense advantage, compounded year after year, to potentially overcome or even surpass the kind of spectacular but much more volatile short-term gains you might see from something like QQQ?
When does steady, low-cost compounding potentially beat flashy, high-volatility growth?
Exactly. That's the multi-decade question. Does the tortoise eventually beat the hare because the hare pays higher fees and sometimes crashes? That's the calculation every long-term investor grapples with.
A perfect question to ponder. What a fantastic breakdown. Thanks for walking us through that. We'll leave you all to think about that cost versus growth equation. Thanks for joining us on the Deep Dive.